Welcome to the Wisdom of Wealth channel. If Wall Street were a martial arts world, it would be filled with various schools, each with its own philosophy and unique techniques. Every school would have its iconic master. Among them, value investing would undoubtedly be the one with the deepest inner strength, and its most renowned representative would be the legendary Warren Buffett. Today, however, we will share the wisdom of another master of value investing, Buffett's senior fellow disciple, Walter Schloss. Both were disciples of Benjamin Graham, the father of value investing. When it comes to Walter Schloss, Buffett Sr., it's worth noting that he didn't have a high level of formal education. After graduating from high school, he stepped into Wall Street and began his career as a messenger delivering documents. Not long after, he began studying under Benjamin Graham and joined Graham's firm in 946. In 1955, Schloss set out on his own and founded Walter J. Schloss partners over nearly 5 decades of investing. He delivered an impressive average annual return of 20% for his investors. In 1998, Schloss gave this precious speech titled My 65 Years on Wall Street, in it he humorously and lightheartedly shares stories about his mentor Graham, who stood firmly by his principles, and his junior Buffett, a once minus in minus entry genius. Schloss was known for a rarely spoken public, which makes this speech all the more valuable. Offers a genuine look at how Schloss inherited and carried forward Graham's investment philosophy. Trust me, investing your time in this speech will someday reward you with a tremendous return in decision-making ability. Let's have his speech.
I have a friend who works as a doctor in a psychiatric hospital. One day, he asked if I could give an investment talk to some of his patients. I said, sure. After he introduced me to the audience, I began my speech. Not long into it, a big guy in the front row stood up and shouted, "Shut up, you idiot! Sit down." I turned to my friend and asked what I should do. He said, "Sit down." That's the first sensible thing a GS said in months. All right, back to the point. I want to talk about Benjamin Graham. He was a huge influence on me, and I think you'll be interested in his early experiences as well. As most of you know, Graham graduated from Columbia University and went on to become a fund manager thanks to his remarkable talent in investing. In the 1920s, his method of managing funds was quite unusual when he made a profit. He took 50% of it when he lost money. He bore 50% of the loss. That kind of arrangement wasn't common at the time. He performed well consistently until the 1929 market crash, which severely affected his investments. To make matters worse, many of his partners, either in need of cash or suffering losses elsewhere, began pulling their investments. That made Graham start thinking hard about how to avoid falling into the same trap again. The losses left him deeply frustrated, as they would for anyone. So he began researching how to avoid losing money. One of his conclusions was invest in companies whose market prices were lower than their working capital. And back in the 1930s, there were actually quite a few such stocks. In 1936, Graham founded the Graham-Newman Corporation. In my view, that firm operated with a hybrid structure, something between an open mind ascendant, a closed mind ascend fund. He allowed shareholders to freely buy unredeemed shares, but when new shares were issued, existing shareholders had the right to subscribe at a discount to net asset value. In other words, if existing shareholders didn't want to exercise their rights, they could sell those rights instead. In early 1946, I left the Army and joined Graham's firm as a securities analyst. At that time, the Graham-Newman Corporation had already been running for 10 years and was performing excellently. That was largely due to their strategy of focusing on secondary stocks, companies with average earnings but strong net assets. After the war, that strategy paid off. Why? Because the excess profits tax heavily penalized asset minus light businesses, while capital minus heavy firms. Those that had contributed to the war effort were exempted, ended up making a lot of money. Their stock prices rose significantly, and Graham earned substantial returns as a result. When those stock prices went up, Graham felt they were no longer cheap, so he decided to sell them off on a large scale. When I started working at the firm, the portfolio held 37 common stocks. For that time, it was a pretty large portfolio. The firm managed for dollars, 1 million, of which $1.10 was invested in common stocks. I checked the portfolio as of January 31, 1,946 among the 37 stocks. Only 2 companies still exist today. The rest were either acquired, merged, or went bankrupt. The 2 surviving firms were A Continental Corp and Grom Ines Hill. Even then, the holdings in these 2 companies were relatively small. At that time, the portfolio didn't just include industrial stocks. It also held shares of investment companies and insurance firms, like American Surety. In addition, Graham's portfolio contained bonds of bankrupt companies, convertible preferred stocks, and short positions in the corresponding common stocks. The strategy was this: if the stock price went up, they'd sell the preferred stock to realize long minus term capital gains. Meanwhile, short positions in the common stock would result in short minus term losses that could offset those gains. This setup made them a good amount of money. Of course, this kind of approach wouldn't work in today's market. In short, my job at the time was to find undervalued stocks. We paid special attention to companies whose market prices were below their working capital, but such stocks were not very common. Let me give you an example. There was a company called the Easy Washing Machine Company. It had Class A shares circulating in the market, while its Class B shares were entirely held by company management and family owners. You probably know that in the 1940s, many companies were typical family minus run businesses. About a decade ago, there was an off-minus Broadway play called Other People's Money. Some of you may have seen it. It was a classic story. A small family business in New England was struggling. The company wasn't making money, profits were thin, and the family members didn't want to invest more capital. Then, a man from New York showed up and offered a decent price to buy the company, but the chairman didn't want to sell. The play was full of strategic games and tug-minus of minus war. In the end, the family decided to sell the company. The man from New York immediately liquidated it and fired all the employees. However, the family members made a substantial profit from the deal. A lot of what really happened back in those days was not that different from this play. Speaking of real minus life stories, everyone knows Warren Buffett. He once shared an interesting episode with me. Back then, he owned a large amount of Berkshire Hathaway stock, which he had bought at around $8 to $10 per share. At one point, he approached the management and said he wanted to sell some of the shares back to the company at a specific price. The company had a history of doing buybacks. The chairman initially agreed to repurchase the shares at $11.50 per share. But when the actual offer came, it was lowered to $11.38, even though it was just a 12-cent difference. Buffett was furious. He decided to turn the tables and acquire the company, instead eventually taking control. So sometimes, trying to save a few cents can lead to unexpected consequences. One of the strongest impressions Graham left on me during my time working under him was his unwavering commitment to principles he simply would not compromise. I had a friend who worked at an old-line railroad brokerage firm called Adam Peck. He told me about a company, the Pittsburgh, Fort Wayne, and Chicago Railway, that had issued preferred stock with a lease term of 999 years. At that time, the Pennsylvania Railroad had just gone bankrupt. Firms like Adam Peck, which specialized in acquiring railway lines, were particularly interested in assets like these. That friend also mentioned a company called Halo Id, based in Rochester, which made photographic paper. Even during the Great Depression, it continued to pay dividends and maintain solid financial performance. Halo Id held a patent for a new kind of copying technology, and my friend suggested I take a look at its stock. Back then, this was around 1947 or 1948, the price had already risen from $13.17 to $21 per share. I thought, even if we paid a little more, say, for dollars extra, the potential returns could still be significant if the technology materialized. So, I brought the idea to Graham. He said, "No, Walter, we don't buy that kind of stock." Later, we all found out that Halo Id became Xerox. That experience taught me how deeply Graham stood by his principles. Even when facing a stock with enormous potential, he would strictly adhere to his investment standards. To be honest, the only comfort I had was this. Even if we had bought it at $21, by the time it rose to $50, we probably would have sold it anyway. Because we never bet on product potential, we only looked at book value. When it comes to these undervalued stocks, there's one thing that must be made clear. We could never predict their future earnings. Some growth stocks, like Freddie Mac, allowed you to estimate their profits several years ahead. But the kinds of second-ear stocks we invested in were nearly impossible to forecast in terms of future performance. We never said things like, "This year's results are bad, but next year they'll turn around." Our strategy was simply to buy stocks that were depressed and neglected. Today's market valuations are very high. Nearly every stock has already been analyzed and picked over by analysts. There are 34 Garo registered analysts out there. It's incredibly hard to find a truly undervalued stock now. Let me give you an example. You might not like it, but it's the kind of stock we used to pay attention to. There's a company that was once a component of the Dow Jones Industrial Average. Now it's barely hanging on. Its market cap is just $2 billion, but it has $40 per share in net assets. A few months ago, during a major market drop, its stock price fell as low as $17. It recently announced a dividend cut by half, and investor interest in it has all but vanished. The company is called AS, IRCO American Smelting Unrefining Company. It's a copper mining firm with major resources in Peru and the U.S. It has no growth potential, and the market has no love for it. But it's asset minus rich and very cheap. Now, I'm not trying to pitch this stock. What I want to show is that the kind of stocks we like are usually the ones the market doesn't. Back in the Graham minus Newman days, we worked the same way: find undervalued stocks, buy a lot, and sell when they go up. When I first entered the business, our portfolios rarely contained industrial stocks. For example, we once held shares in Jones Lamson Machine Company, located in Vermont. It was a manufacturer of machine tools. After the war ended, the market had a very pessimistic outlook on such companies, but we were willing to buy them. We also invested in New Britain Machine, Another firm that, on the surface, appeared to have little future. It was the kind of stock that looked hopeless. Here's another example before World War II. Boeing was a market darling. Its stock once traded as high as $45 per share, while its book value was only $20. But by 1946, the market had completely lost faith in it. The stock price dropped to $20, while its book value had risen to $40. Naturally, we preferred to buy it at that point when it was unloved by the market, not when it was being hyped. Unfortunately, most investors only want to buy companies when they're doing well, when they're shining. Only a very few are willing to step in when a company is in trouble. We chose to go the other way. And can we wait? When others were selling, we were buying. When others were afraid, we added more. Say a stock drops from $30 to $25. We might keep buying. But our clients would often feel anxious and wouldn't want to add to the position. So, we had to move quietly to avoid upsetting them. Doing this kind of investing requires a big heart, being able to endure paper losses and still have the courage to buy more at the lows. This is really the essence of contrarian investing. Although Graham himself never used the term, he just focused on whether something was worth buying. When I first joined the firm, I had never seen anyone buy as stocks were falling until I saw Graham. I still have a copy of the investment report issued by Graham Newman in January 1946. It's 6 pages long, photocopied, and I've kept it upstairs. Anyone interested is welcome to take a look. The firm had just reached its 10-year anniversary at that time, and I had joined right around then. My first task was to help prepare that 10th- anniversary annual report. I hope this brief introduction to Graham has been satisfying. I've always tried my best to put his ideas into practice, although I must say it's much harder to do so nowadays. We can hardly find stocks trading below their working capital value anymore. Even those trading below book value are getting rare. Most of the called cheap stocks today are problem companies, ones the market is desperate to avoid. But we still stick to one core principle: whether a stock is worth buying depends solely on its price, not on market sentiment. As Graham said in The Intelligent Investor, buy stocks like you buy groceries, not like you buy perfume. This line may sound outdated today, but it remains the heart of value investing. To me, investing has never been just a numbers game. It's a discipline, one that requires patience, consistency, and conviction. We never try to predict the market. We focus only on finding undervalued assets. We believe that as long as we buy cheap enough, keep risks low, and diversify, we can achieve solid long-term return. I'm not a genius. I've never claimed to have a crystal ball. I just stick to what I understand and what I believe in. That has been enough to keep me in this business for nearly 50 years. When the market heats up, I prefer to stay calm. When others get greedy, I become cautious. When others panic, I enter the market to look for opportunities. This path may not be flashy. It won't make you rich overnight, but it's safe, grounded, and perfect for investors who are willing to think, wait, and follow their principles. Thank you all for listening.